All right, let's talk about Texas Instruments. What's going on with the stock, and why it's making headlines again. So first, who are we even talking about? Texas Instruments, or TI for short, is one of the major players in analog and embedded chips. These are the workhorse components that go into industrial gear, factory systems, electric vehicles, and a ton of other electronics. TI's chips aren't flashy like GPUs, but they're absolutely critical, and TI has built a global business around that. It's a top 10 global semiconductor company by revenue. But lately, it's been a rough ride. Earlier this week, TI's stock took a serious hit, dropping over 6% in a single session and hitting a fresh 52-week low. It even dipped below $140 intraday before slightly recovering. That's a pretty sharp fall for a company this size, and it wasn't just about weak earnings. One of the big triggers? China. Apparently, the China Semiconductor Industry Association issued an urgent notice about scrutinizing the origin of imported semiconductors. And since TI has significant business exposure to China, that headline alone was enough to spook investors. The fear is that if the trade war escalates again, companies like TI could end up in the crossfire, either directly through regulation or indirectly through supply chain disruption and customer behavior. This isn't happening in a vacuum. The trade war narrative is back in play, especially after the former U.S. president recently proposed a sweeping 10% tariff on all imported goods. That's not a semiconductor-specific tariff, but come on. If tariffs go up, costs go up, and eventually that's going to filter down to demand. JP Morgan flagged that exact risk. Even if chips don't get taxed directly, higher prices across the board can kill demand and shrink volumes. Now add in some good old-fashioned business headwinds. KeyBank noted that industrial and automotive demand is still cooling off. These are two of TI's biggest end markets. On the automotive side, things were particularly underwhelming. A quarter ago, there was some optimism about recovery in China's auto market, and that actually did materialize to some extent. But in other regions, not so much. TI themselves admitted, industrial and auto haven't hit bottom yet. Let's dive into their recent guidance. TI came in roughly in line with revenue expectations for Q1, but their EPS guidance? 10% below consensus. That's a red flag. The culprit? Higher depreciation and lower factory utilization. Gross margins that used to be in the 70s are now down to the mid-50s. That's a massive contraction. And remember, we're not just talking about a one-off quarter. They've been under this pressure for a while now. Management is calling it temporary. They're saying utilization is just low right now and it'll bounce back. But inventories keep piling up. At the end of Q4, TI was holding a record $4.5 billion in inventory. That's up 5% from the previous quarter and up 13% from a year ago. They're now sitting on 241 days of inventory. That's way above their target range. So the question is, how temporary is this really? And this affects more than just the gross margin. When factories aren't running at full capacity and product isn't moving fast enough, you don't just lose margin, you lose efficiency, you lose flexibility, and eventually, you start losing pricing power. That said, not everything is doom and gloom. There are some positives. China was actually a strength in Q4. Revenue there grew again year over year, especially in the auto segment, largely thanks to electric vehicle demand. And even though overall automotive revenue was down in most regions, EVs provided a little bit of cushion. Also, cancellation rates remain low and stable. That's actually a pretty good early signal in the semiconductor world. When customers stop canceling orders and start placing more last-minute, in-quarter orders, what the industry calls turns, that can signal a rebound is on the horizon. And TI is seeing some signs of that. Then there's cash flow. Free cash flow came in at over $800 million last quarter, the best performance since 2022. And looking forward, TI is expected to benefit from a drop in capital spending starting next year, which could unlock a much stronger FCF profile. In fact, 2026 could be a major inflection point for them if all goes according to plan. But the big issue is timing. Investors are asking, when is this recovery actually going to materialize? And more importantly, how strong is it going to be? Analysts are divided. Some are optimistic, saying we're near a cyclical bottom and that TI could re-enter an earnings growth cycle by late this year. Others are more cautious, pointing out that TI's stock is trading at a premium, about 31% above the average stock in its sector. That's a bit rich given where margins and utilization are right now. So even if things improve, the valuation may already be baking in a lot of that upside. And while we're on valuation, let's be real. TI is a solid company with a long-term strategy that's focused on analog dominance and building in-house manufacturing. That's admirable. But when the short-term numbers aren't adding up, and inventory is climbing, and macro conditions are volatile, it's hard to fully lean in. So here's the bottom line. Texas Instruments is navigating a tough environment. You've got trade tensions, inventory headaches, demand softness, and margin pressure. But on the flip side, you also have steady cash flow, low cancellations, and a long-term growth plan that could still play out well over time. Whether you're already in the stock or just watching from the sidelines, now's the time to really dig into the numbers and stay alert. There might be opportunities down the line, but this isn't the kind of stock you want to buy on autopilot. Let me know what you think. Is TI a long-term buy at these levels, or would you rather wait until things stabilize? Drop a comment below, and don't forget to subscribe if you want more market breakdowns like this. See you in the next one.